Hi everybody, welcome back. In the last video we talked about the Federal Reserve System. We talked about its organization and we talked about different monetary policy tools. So those were open market operations, the discount rate, and reserve requirements. So reserve requirements, again, they dictate how much of a bank's deposits must be held as reserves. In this video we're going to go into that in a little bit more detail, talk about reserve requirements, and actually show how not only do reserve requirements affect the size of the money supply, but the changing the reserve requirements also creates new money inside the banking system. And so through the process of lending, banks actually create money, almost out of thin air, right? So we're gonna talk about what that is and how that looks, and yeah, so let's go ahead and dive in. So, first of all, let's think about what banks do. So, on kind of the two sides of what in accounting is the balance sheet, you have assets and you have liabilities. The core kind of function of a bank is it's going to take deposits. So if I have extra money that I'm not using for something, I'll go deposit it in the bank. And then the bank is going to take the deposit and it's going to make a loan. Ultimately, what banks really are is there's somebody who has extra money and there's somebody who has a good idea, or maybe they want to buy a house or a car, or they're a good idea, they want to start a business, but they don't have much money. Theoretically, I could go and lend some money to that person, but lending money is a kind of a complicated thing. There would have to be a lot of trust involved, or we'd have to get lawyers involved, and there would be a lot of cost. So instead, we have this intermediary, the bank. And so I put my money in there. The bank takes that money and lends it out to that person. So the bank is acting as a financial intermediary to take people who have extra cash to the people who need cash. And that's what's happening. So fundamentally, that's what a bank does. That's a simplified model of everything that they do. There's certainly a lot more. But this is what we're going to kind of base this off of, and that's really going to help us understand what reserve requirements are and how they work. So, again, so what are reserves? These are deposits that banks have received but have not loaned out. Deposits that banks have received but not loaned out. Right? So these are, in the basement of the bank, right, in the vault. Right? That's supposed to be a lock. There's going to be some money down here in the vault that are the cash reserves of the bank, and that money is held on reserve. And if somebody comes and they need a loan, the bank will take some of that and lend it out to the next person. All right, so to think about and understand reserve requirements and how that monetary policy tool affects the banking system, we're going to look at two systems: 100% reserve banking, which is not very common, and fractional reserve banking, which we have in the U.S. and many other countries as well. So for this, we're going to be using an example, and we're going to start with this idea that I'm going to go to the bank and make a $1,000 deposit. All right. In the case one with 100% reserve banking, it's actually going to be pretty simple. The bank keeps 100% of the deposits on reserve, and it doesn't make out any loans. So what is this going to look like from sort of an accounting standpoint? crash course in accounting really quick. The accounting of banks specifically. So this is a balance sheet. And the reason it's called a balance sheet is because it has to balance. And so on one side, we're going to have assets. And on one side, we're going to have liabilities. And in more complicated, you'd have liabilities and also owner's equity, or capital, it's sometimes called. But let's keep things simple. So deposits are a liability. Basically, what this means is if I give $1,000 to the bank, they are liable, they're accountable for providing me that $1,000 back if I go and ask for my money. So, another thing, we're not going to write it here, but borrowings would be another one. If a bank borrows money from another institution, they are liable to pay that institution that money. So, the bank is liable to pay me $1,000. Total deposits is just going to be that $1,000 for this example. Okay, what does the bank do with this $1,000? Well, it could do two things in our simplified version. It could make loans with that money, or it could keep that money in its reserves. Generally, we could think of this as cash or what's in the vault. But with 100% reserve banking, they have to keep all of the money in reserves. That means zero of it can be loaned out. And so total assets is going to equal 1,000. Okay, and so what do we have? The balance sheet balances, we're good to go. This is not very interesting because there's nothing really going on here. What will happen to the money supply? In this, if you haven't seen it, go back and watch a couple videos ago. I talked about what the money supply is, how we measure it, the difference between M1 and M2, M1 being the more liquid money supply, which includes currency. So initially, I had $1,000 in currency. Initially, the M1 is equal to the $1,000, which I was holding in currency or cash. And the M2, after the deposit, the M2 has that $1,000 because I've put it into a, did I say savings account? Savings deposit. Because remember, M2 is made up of all of M1, but also the savings deposits. So I'm just going to put SAV for a savings account. Also, just note, after the deposit, the M1 that goes back to zero based on that original amount, because that currency is not held as currency anymore. It's held as a savings account. The other interesting note is that initially, I'm going to make a small change here. The M2 initially is also equal to 1,000 because M2 is equal to M1 plus all this other stuff, including savings accounts. So the M2 is always 1,000. M1 was 1,000, but it moves down to 0. Okay. So if that's a little confusing to you, go back and review that that first video in the series where I talk about the money supply. Okay. But long story short, if we use the M2 to measure the money supply, there's no change. Okay. And in general, also, don't worry too much about that because reserve banking is not 100% reserve banking is not very common. What's more common is fractional reserve banking. So, how does this work? Well, the bank keeps some of the deposits in their vault, but then they use the rest and they make loans. And so the amount, the fraction of deposits that they hold on reserves, that's the reserve ratio, and then the rest is the loans. So reserve ratio, the fraction of deposits that banks hold as reserves. The fraction of deposits that banks hold as reserves. And the formula for that is the reserve ratio. Well, we could write it a few different ways, but the amount of reserves is equal to the reserve ratio times the amount of deposits. We'll do an example of that here now. And through this system, as I said before, the banking system and this process of lending actually creates new money in the banking system. So what we have here is the money that is loaned out ultimately ends up in another bank's deposits. Which then a portion of that gets loaned out. A portion of that, let's say that deposit, gets loaned out. And then we have this process carrying on and on and on. So since I'm in a kind of a drawing mood, let me draw that. Again, let's start with me, the initial depositor, and let's say I have $1,000. Let me use the same 10% reserve ratio. I have $1,000 that I don't need to spend right now, so I'm going to put it in the bank. The bank, they take some of that down to the basement, to the reserves, and they're going to put 10% of that in reserves. That's $100. And the rest is going to be made as a loan for $900 to the next person. Okay, so now this person has $900, and let's suppose that they exchange $900 to the car dealer for a car. All right, now the car dealer has $900. What does the car dealer do with that money? They can go either back to that bank. Let's use a different bank. The car dealer takes their money to their bank, and now that bank, who maybe also has a 10% reserve ratio, they keep $90 in the vault, 10% of 900, and now they have $810 left to loan out to another person. And so they're going to lend that out to another person. That person now has $900, and they're going to use that $900 to get something in exchange. And then this cycle is just going to repeat itself over and over and over. And so this $1,000, I can still go back to the bank and I can ask for my $1,000 back. And I'm going to get the money, right? But the same thing can be said for this car dealer. The car dealer put $900 in the bank. Let's suppose after all of this happened, I ask for my money back. The car dealer asks for their money back. And what's happened? This person still has the car. This person still got their loan as well. I have $1,000, but the car dealer also has $1,000. That's $1,900. So the banking system has turned my $1,000 into $1,900, and it's going to continue, right? When this next loan goes on, that deposit is going to add another $810 to that, and so this cycle will continue, and that's this idea of the banking system creating new money, because it started with 1,000 and it's ended up with more. So this is kind of the visual representation of what's happening. Unfortunately, we're going to move back to maybe the less interesting accounting description of what's happening. So let's go ahead and do that. We're going to do the same. We're going to build our balance sheet. Same example as what I just drew. We have assets and liabilities. Remember, they must balance. I put my initial $1,000 deposit in the bank. So total deposits are 1,000. Those have to equal. So what can the bank do with that? They can make some loans, or they can hold some in reserves. Because banks want to make money, they're gonna try to make as many loans as possible most of the time. So if they have a 10% reserve ratio, they're just going to keep that 10%. 10% of 1,000 is 100. They're going to put in reserves. The rest they're going to lend out, right, to that guy who wants a car. That's going to equal a total of 1,000. Balance sheet balances. And what happens? This is that new money that gets created. Actually here. So the bank, from that first deposit, created $900 of new money. That is this. And so what happens next? The bank, that $900 ends up in another bank, opt for another loan. Let's build that second step. So the car dealer, they take their money off to the bank, and they deposit that $900. So the total liabilities, 900. Loans and reserves, 10% of 900 is 90. That leaves 810 left to make loans for a total of 900. Total assets. So there's another $810 created through the banking system. And this is going to keep going. So there's going to, 10% of 810 will be kept as deposit. The rest is off to the next borrower. And then the fourth, fifth, sixth, and it's going to continue on and on and on. So in the end, how much new money is actually being created here? Well, we can calculate that. And to do that, we'll use this mathematical formula called a geometric series. And if you have some sequence of numbers that look like this, which just for kicks, I'll write this out in the summation notation if you're interested. I from 0 to infinity of x to the ith power, because if you recall, x to the 0 is equal to 1, and this would be x to the 1 is equal to x. So anyway, you don't necessarily need to know this part in particular, but the thing that is nice about this is that this series will converge to 1 over 1 minus x. That is, at least as long as x is less than 1. Actually, I think x needs to be between 0 and 1. Okay, and we can use this geometric series to understand how much money has been created in the economy. Let's go ahead and do that. So the first deposit was $1,000, then $900, then $810. The next one would have been $729. Mathematically, what is $1,000? I mean, what is $900? $900 is just 1,000 times 0.9. What is 810? That's 1,000 times 0.9 squared. 0.9 squared is 0.81. That's going to get the 810810. Okay, 1,000 times 0.9 cubed is 729. So hopefully you're maybe starting to see where we're going with this. But if you're not, what we're going to do next is factor out all of those terms have a 1,000 in them. This 1,000 is just multiplied by 1 plus 0.9 plus 0.9 squared, 0.9 cubed, and on and on and on, out to infinity. And so what we have here is 1 plus x squared plus x cubed. X in this case is just 0.9. And actually, I need more space here. Let me just mess around with this a little bit. Okay, I'm going to put that over here. I didn't leave myself enough room. Oops. Okay. If we carry on with this math, what do we have? Well, we know that I'm gonna make this a little smaller. This series here is going to converge to 1 over 1 minus x, right? And we just said that x in this case is 0.9, so this is going to converge to 1 over 1 minus x, which is 0.9. That's going to be 1,000 over 1 minus 0.9 is 0.1. And I'll just do an extra step. 1 over 0.1 is just 1/10, and so we can move that 10 up to the top. 1,000 times 10 for a total of $10,000. So what happened? We started with a deposit of $1,000, and that through the banking system turned in to $10,000 through that process of depositing and lending and depositing and lending. And so this is what we end up with, $10,000. Now, we did this a long way. Fortunately, there's a much simpler calculation for this. And that is the money multiplier. So the money multiplier is the amount of money the banking system creates with each dollar of reserves, calculated as 1 over the reserve requirement, or the reserve ratio. So a couple examples there. Well, 1, what was the reserve ratio in our case? If you recall, it's 10%. 10% equals 0.10. What do we have down here? 1,000 times 1 over 0.10. That is the reserve requirement right there. And so just to do another quick couple of examples, if the reserve ratio is equal to 5% or 0.05, then the money multiplier is going to be equal to 1 over 0.05 or 20. So if there was a 5% reserve requirement, that initial deposit would be multiplied by 20 times for new creation of money in the banking system. If the reserve ratio was equal to 20% or 0.2, then the money multiplier is equal to 1 over 0.2 for 5. So what's the policy implication? Here we have a higher reserve ratio. Here we have a lower reserve ratio. And because that's divided, since it's in the denominator, lowering the reserve ratio means more loans will be made out with the deposits. Lowering the reserve ratio or reserve requirement means more loans will be made with the deposits. And so if more loans are made, the money multiplier will increase, and the money, let's say new money, created by the banking system will increase. Okay, and that's the general idea. I guess if we just follow that up, that means the money supply will go up. If the money supply goes up, as I showed, I believe in the last video, the interest rate decreases. If the interest rate decreases, people will invest more, people will buy more, consumption and investment go up. Consumption and investment are part of GDP. That's going to make GDP go up. So what do we do if we're in a what does the Federal Open Market Committee do when we're in a recession? Among other things, decrease the reserve requirement. That's going to help try to stabilize and stimulate the economy. All right. Yeah. So the Fed, it can set reserve ratios and affect monetary policy in other ways. Open market operations are largely the case. And so that is kind of a nice high-level overview of how the Federal Reserve System works, how monetary policy works. I'll explain just a little bit more details as we go into the next video. And show some statistics and current numbers for the money supply, for the for the reserve requirements. These can all be seen on the Federal Reserve's website. Yeah, and so that's what we're going to be doing next. Thank you again for watching, and I'll see you in the next video.